the lease. Oh, hold on a second. Okay.
Yeah.
Once that's this is basically a 3-year open contract, which means
This is a 3-year open contract.
Which means at any time he can purchase it. So how is the purchase price adjusted depending on whether he buys it on the first year or the third year?
Okay, so it depends on the area. A lot of areas we add 6% appreciation from day one. So let's say you do the transaction today and he wants to buy it back tomorrow.
Mm-hmm.
It's already 6% added till 1 year. The first year is added 6%, and next year another 6%, and next year another 6%. So at least you make immediately. It's a $500,000 house. You make $30,000 right away.
Mm-hmm.
If he buys from day one, and if he buys after 1 year, already principal pay down has happened. So you will make in the first year, if he closes, 40 plus to 50,000. Second year, if they close, it's around 80. Third year is over 100,000. This is average around for that price.
Okay. My second question is: no part of the actual rent is deducted from the eventual purchase price. It's basically just the option fee that's deducted.
Yes, the option. No. Today I'm going to talk about the system. In fact, so I'm going to go into very nitty-gritty and details. Okay, so today we'll be discussing about all the minor details, because I know a lot of students have,
I have a last quick question. Once the patient, that's occupational hazard. Once the client goes to the bank, does he qualify for a mortgage based on the full purchase price, or based on the price less the option fee?
That will be discussed today as well. So I'm going to discuss in detail. So I will wait for the rest of the students to show up so that they don't miss. But it's a beautiful question. We'll answer them all today. We'll go in very detailed discussion today about the whole system, how we create multiple streams in the system. The idea is to really create multiple streams so that when you have lots of streams on your side, it becomes very easy to negotiate. People love what you can do for them. And in this system, there are a lot of things we can do for our tenant buyers. So they're going to love once I present the whole system. I think we'll go into very much detail. I'm just going to give the other guys few minutes to show up. Yeah, we still are 1 minute early. Ruby, how are you today?
Very good, sir. How are you?
How's everything going on with you? Any questions so far? Anything that you would like to have answered before we start today's training?
No, not really. We can start from here now.
Okay, Arun, how are you?
Good.
Good? Just good or very good?
Very good.
Very good. I want you all to be very good. Very simply is beautiful. I want you to be all very good. Very simply is I really want you to achieve success. So you will see that from time to time, I will be making changes to the courses. You will see that I want to speed up the time in which we finish the studies. The reason for that is very simple. I want to give you more one-on-one time. So this week we are announcing I'm giving you 1 week more of one-on-one training. So the first 5 weeks will be group training. 6th week onward is going to be one-on-one. Very simple, because I want to nail down the deals. I want to get the deals done. I don't want to be just teaching and teaching. Okay, I want money in the pocket, in your pocket.
That's right. Yeah.
Okay, so that's what we'll be doing. Let's wait a few 2-3 minutes more, and then
I will have my.
You have filled up your forms?
Yeah, I just need to put it on the system,
Yeah, beautiful. I need that, and so I think by the end of the day today, you will be receiving another form that I need your logins, and I need those password, username, and password so that we can start building you up the funnel. Because we want, there were some glitches with Wufoo forms because we wanted to set up the form through them, and they called me back and they said we cannot take passwords over their system. So I had to delete that form, and we'll do it separately via email. I think they changed some policy.
I even didn't receive the first one, I remind you on that day as well. You said that you will tell the office to send.
No, we put it up on the system. We put it up on the system, but the problem is they blocked it from seeing. I wasn't aware that it was being blocked because we were asking for the username and password. Only when students complained to me, and I got an warning email from them that we cannot take passwords over the system of Wufoo. So then we are going to send you separately now via Word file or something like that. Oh, you will receive it by the end of the day today.
Okay. So that will be
about the forms?
in the email, right?
Yes, an email. It will be in an email. It will be a form in which we'll be asking you all your logins for all the things that we wanted you to set up so that we could set up the funnel for you. How are you, John, today?
I'm good, thank you.
How's the weather in India?
It's good. It was raining earlier. Coming
Okay,
into the rainy season.
that's true. That's true. That's very good. Okay, any questions so far in terms of, I know you've been a great student so far. You've been trying to rush through everything.
Yeah, I got a little stalled this week. I had some computer problems, but going through it fine. Were you going to send me your phone number? I did have a couple questions.
Sure. So the way you do is you will have all my personal phone number. You can contact me, but I'm always on the phone. I receive average 200 calls a day. So sometime I will miss your call. So what happens is just text me. Okay, text me the best time to call you back. I can call you back, or I can reply you via text. That's the best because then I don't miss a thing. Okay, but you will always get reply by the end of the day, if not early next morning, if I'm just too busy at the end of the day. Okay, any other questions you guys have before we start today's training?
Gurmeet, one question. So we talked about two different forms, right? And the login?
Yeah, one is your personal status, the current status. I want to know where you are at right now. Okay, where are you? How many properties do you have? What kind of assets do you have? What kind of liabilities do you have? How's your credit score and all that info? The idea is I want to know what technique should I apply in your particular case. And because in this training, I cannot teach you all that I know about real estate. There are 30, 40 techniques. My goal is to focus on one or two techniques, make you an expert on it, and start making you money in that. Because all techniques make money, I can tell you. All techniques make money. Some a little bit harder, some a little bit easier. So what I want to teach you is one or two specialized techniques in that to start making money. And I want to know which stage you are at so that I can take you from that stage. I know majority of you where are at, but I might be able to give you insight into your current status. Because let me give you an example. One of my students from the previous class, he was, I think, 68 or 69 years old. And he came to me, he said, Gurmeet, I'm working on 2 jobs and I'm still not making a living and I want to learn real estate investment. And he said, my sons have already moved out of the house and I don't know how I'm going to do it myself. So he works in Brampton Guardian, and he's from Brampton. He works in Brampton Guardian, shuffling those, stuffing those flyers into that. And he works as a security guard, and he wants to start real estate investment. At his age, I told him I cannot make him a real estate investor in a full scale. All I can teach him some smart techniques, because there are a lot of, especially in Ontario government, in Canada, they got a lot of restrictions to advisors, what you can advise at what age. Okay, so what I told him very simply is I will show him 1 or 2 techniques. So what we did, we took out the equity out of his house. He had a last minute contribution that he could do to his TFSA. We put that money in the TFSA. We bought it in his daughter's name, who was still with him, the property under the corporation, showing it at arm's length. I think his deal, he will make $55,000. So all the profit from that deal is going to go his TFSA tax-free. So there are a lot of street smart techniques which we have figured out how to do those. So we will be teaching you. That's why I need to know the insight. Like a doctor cannot cure you unless he knows your disease. Very simply, my goal is not to dig deep into your personal affairs. My goal is very simply, I want to know where you are at. So whatever you're comfortable sharing, I want you to share.
We are very much happy to provide you that all the information. I'm still waiting for the forms.
Because the more information you provide, the more accurate the assessment and the technique will work.
Yeah, I'm still waiting for the forms.
We didn't get the form yet.
You will get it today, because we had a glitch with Wufoo. We had a glitch with Wufoo. We had it on Wufoo. We sent it to everybody. We didn't know that they had blocked us. Okay,
so basically about the TFSA money, so that can be used from one family member to the other?
No, at arm's length. Arm's length means, but a corporation is arm's length.
But still the director is, say, for
there's a ways of, I'll teach you the ways to set it around. Okay.
Okay.
I'll teach you. I'll teach you the ways to set it around so that arm's length. There are a lot of techniques. Like I had one client, he had almost 800,000 in his RSPs, and I had the other client who had 500,000 in his RSPs. We cross-invested each other's money into each property and cross-collateralized. So all the profit from one property of the other investor is going into the other investor's account. We did 2 similar deals, and that way you could take it all tax-free. There are a lot of techniques. Not everybody will be comfortable with a lot of techniques. It's all about getting to know the technique first and getting your comfort level up. Once you understand the technique and the best way out, I think they work, because we have done quite a bit. There's trillions of dollars in RSP accounts. And it's one of the biggest sources of our funding in terms of our real estate investment. People are hardly earning anything. They make 4 or 5% in their RSP accounts because it's invested in stocks. Sometimes it can go up and down. Here in real estate, if we are making a very good, we can offer them anywhere 12 to 15% return on that money, guaranteed by real estate. So it becomes very solid rate of return. And then because they are now investing their money into it, we always want a second investor who has similar kind of funding now to invest in their deals. So it's a cross investing between investors. So this helps both ways. Not only they make money in their own deal, they make 12 to 15% return on their money, which they couldn't touch themselves. So it becomes a very profitable long-term.
So basically, all these connections will be provided from the office side.
Just give me 1 second. One of the student is calling and on my cell.
Gurmeet, you're still muted. We can't hear you.
Okay. Now you can hear me?
Yes.
Okay.
Yes, we can hear you.
Okay. Okay, so now you can hear me. That's good. Okay, so let's talk about when you start investing in real estate, what happens is a lot of people go for fix and flips because that's the most visible type of investment. And what happens, let's say you look at fix and flip, you buy a property, you invest money in spending money on buying that property and closing that deal, then you spend money on renovating that, and then when you sell it, that's the income you're going to have. What we are showing here is that you can have lots of different streams of income. Oops. Lots of different streams of income in the system. And what we have done is refine the system further. We have made the system more kind of foolproof, and so that it becomes very easy for you to do the investments. I think my screen, because I've got double screen, and that's what's causing problem. Okay. Okay, sorry guys, because I had a double screen and that's what was causing problem. I'm going to reshare so that let's hope it will be easier. Yes, better. Now you guys can see the full screen? Oh.
Yes.
Okay, let me see it start working. Okay, so So that's where the biggest problem people have is when they're investing, they have only one way of making money when they sell the property. This system that we invented, the ALP automated, there's a mistake here. So is you got multiple streams of income. Number one thing, which I always want in every single deal, is we want to walk in equity. We don't want to do a deal unless it's a bargain. The reason for that is, so bargain can be in a various different way. Is sometimes we can see the value in it, sometimes below the appraisal price, sometimes it's below the listed price. So there are different ways of looking at. The idea is very simple. I want to make money the day I buy the property. Next thing is we want to have good cash flow, because I come across a lot of real estate investors and they say they have bought condos and they're negative cash flow. I don't like, very simply, doing the deals if it's a negative cash flow. That's not real estate investing. You want to have good cash flow. Our properties, minimum cash flow, at least $500-600 per door, if not over 1,000. So a lot of the deals that you will see, the way we have designed, they will be cash flowing very healthy. So if you want to replace a $60,000 yearly income, all you have to do is do 5 small deals, or you will have roughly $5,000 a month of net cash flow. The down payment. So we're going to discuss that, then appreciation, principal pay down, saving on repairs, additional rent, tax benefits, smaller investment, and low closing costs, and split of appreciation. So we're going to discuss each of these points in detail. The idea is very simple. I want to give you in-depth knowledge of the system. Okay. So number one thing is the walk-in equity. When we are looking at a deal, we want at least 10 to 15% walk-in equity. A lot of you say have a mental block that, oh, you cannot find such deals. But when people are in trouble, because remember, our technique is we are not looking for distressed properties. We are looking for distressed owners. When people are in personal trouble, whether they're going through divorce, disease, death, or whatever their situation can be, they want to close that deal. They want to get out of what they have. They want to sell that property. They don't care for a few percent, especially in divorce cases. It can be very, very really frustrating for people who are in divorce and they want to get out. They don't care for the equity. So when we are buying, we want to buy with at least 15% equity, 10 to 15. 10 is the minimum. We want 10 to 15% walk-in equity, because if you're buying a, let's say, $400,000-500,000 house, you're immediately walking into $40,000-50,000. Okay, so our system that we have set up will help you find such kind of deals and will teach you how to negotiate. So the scripts will be provided in terms of what to say, what not to say. Second thing is cash flow. Your monthly cash flow means what you are receiving as rent from the tenant and what you're paying as mortgage. There has to be a minimum of $500-600. Okay, so do not rush into doing a deal if it's cash flowing $100, because you will see through the system there are more than enough deals which will give you cash flow of above $500, okay, per door. So down payment. The next mistake that people who do a lot of rent to owns or lease options, they make a mistake. One thing is that they take somebody with $3,000 down. They take somebody with $5,000 down. I don't do any kind of thing. Our minimum down payment that we want is $20,000. Why? I want almost 1 year's rent upfront, because in case of any problem, and we need to kick out the tenant or whatever we need to. Normally, it has seldom, very seldom, rarely happens when they have put so much deposit. It rarely happens like this when they are giving you $20,000-$30,000 down. It will not happen because then now they got a lot of skin in the game and they don't want to lose that. So you want to be a little bit patient in terms of that. So I was just looking at the deals on hand. Right now, I got 8 clients with minimum of 20,000 deposit who want to do the deals in London area where I recently put up the system for advertising. So what we want to do is activate that system for you so that you could find the deals in your area. And in case we don't find in the time allotted, we don't find a deal, we'll give you or show you the deal options that are available that you can do. Appreciation. We invest in the areas where there's a minimum 3% appreciation up to 10% appreciation. But if you look at overall in Canada, appreciation has been crazy. Even in the US right now, and there in the last 2-3 years, in the GTA area, over average appreciation has been over 10%. So that's what we want to do is, let's say if we are doing a deal and we're charging an appreciation of 5 or 6%, and it's a $500,000, that gives us a yearly profit in appreciation alone of $30,000 a year. So that's what we want to look at. Okay, so in 3 years, you will have an average appreciation of 15 to 18%. So on an average deal of, let's say 500,000 in Canada, it's little going to be higher. For my US students, is the amounts are way lower. The reason the houses are way cheaper there. Principal pay down. So when you are buying a property, because your credit score is way better than the tenants, there's a big chunk which gets paid down. So every month, few $100 principal is being paid down. So longer the tenant stays in the property, the more money you're going to make. So all these different things are giving you the income streams. So the next saving, that next income comes from, because when people do rental properties, they buy, they rent it out to tenants. And if anything happens now, their toilet is broken or the light bulbs is out or some electrical problem happens, now they have to spend money. Under the automated lease purchase agreement, up to $500, the tenant is responsible. Above $500, the insurance company is responsible. So as an investor, we don't pay anything once the deal is under contract for repairs or for maintenance. And that helps a big time because now you can save that money instead of having to spend it on problems. Additional rent. So in my deals, I average do minimum $300 of additional rent, and I've done up to $1,000 or even $1,500 of additional rent. So a lot of you will be surprised. Why would somebody pay you? Let's say somebody's renting a house and the monthly rent is $2,000. And I'm asking them to pay $1,000 more. Why would somebody pay you $1,000 more? Because there's an incentive that we have tied into it. The reason for that is very simple. As somebody, let's say, has put $30,000 deposit and they're buying a $500,000 house, and they will qualify, let's say with the 10% down, they need to save another $20,000. So if they are on a 3-year contract, they need to save every month $600. And a lot of these people, because their credit score is not too bad, they want to qualify in 2 years. So we tell them, okay, why don't you expedite your savings by putting the additional rent. And whatever additional rent you put, instead of putting in the bank, if you put it in the bank is going to give you hardly 1% or even not, or 1/4%. But with us, what we call is boosted saving. Boosted saving is if they are putting $300, we'll give them 30% return on that money. So if they put $500, that 30% will be $150. If they put $1,000, now they will receive almost $400. Tell me, where else can they make this kind of return? So why are we giving them incentive? I'll show you. Because we got enough profit in the deal. All we are doing is sharing some of the profit with the tenant buyer to provide us with the huge security. So if the tenant buyer is giving us, let's say in this deal, okay, $1,100 extra rent, and let's say their monthly rent is $2,000, now they pay extra $1,100. They're receiving back $440 as additional rent from us, as we are helping them save. Why we are doing this is because the way we are doing is we want to help them save more down payment, but at the same time, I want to show in my rental property that my rental property is cash flowing good enough so that I can qualify to buy more houses. So the more additional rent the tenant pays us, the more money we save. But we are giving back $400, let's say in this case, so that's our loss. But that we are doing, let's say you have a mortgage of $2,000 and let's say you got it at 2%. Your principal pay down at 2% is going to be, okay, I recently did a deal at 1.45%. At 2%, the principal pay down is going to be almost at $1,100. And if we, out of $1,100, we give them $400, we are still saving $700. But now the tenant is so encouraged to give you extra money because they are receiving this additional rent. And if they put more money with us, we are able to now qualify for more deals because our property is cash flowing excellent. Because now it says a cash flow. When we go to the bank and say, I have 5 houses, I want to qualify for the 6, because now each property is cash flowing $1,500, $2,000. It gives us a lot of additional income to qualify. Okay, so and I'll show you how to compensate this loss that you are having here. Don't consider it as a loss, it's an incentive. I'll show you how to compensate it back in the few next slides. So it's a win-win situation. So once you give the tenant additional incentive to put more money with you, very simply put. Okay. Now there are a lot of tax benefits as well, especially in the US. For US students, they can deduct their mortgage interest. In Canada, under the ALP, the Automated Lease Purchase System, we can qualify the deal to be as a capital gains. Because if you're buying an investment property and you are flipping regularly and you're doing a lot of deals, it's considered as trading income. Once it's considered as trading income is way higher because it's added to your income. So under the rent to own, under the automated lease purchase system, these deals qualify for capital gains because the deposit is non-refundable. So your contract is very important. You will be provided with copies of the contracts. So you can check these contracts with your lawyers, with your accountants We have tested them time and time again on hundreds of deals. They withstand because our lawyers have designed them. But I'm not a lawyer. I'm not an accountant. So when I'm giving you any such advice, I want you to not take it on the face value. I want you to double check with your lawyer and accountant because they are the licensed ones. Okay. Smaller investment, and let's say we are buying a $400,000 house and the client is already giving us 20%, $20,000, mean they're giving us 5%. And if we're buying that property with 10% down, like one of my students is right now doing a deal with 10% down, it's their first time buyer house. So they're putting only 5% of their own money. And so because they have a smaller investment, the rate of return on their investment is way higher. Lower cost of closing. This is another interesting fact that we do into it. When we are specifically buying for a tenant buyer, a house, the closing cost is added to their purchase price. Let's say we spend $10,000 on the closing. When we bought a house for $400,000. So when we are adding that 6%, we add it on 400,000 plus our closing cost, which is 410 plus 6%. So we recover back our closing costs in the deal. Okay, so then you can ask these very questions when you are doing a very deal is how much profit will this investment create? Okay, and how much long my capital is going to be blocked into the deal. Okay, am I driving the profit in the right way? And all those, you can go through all those questions very simply. Okay, with the ALP system, the way you are making money is you're making money in 3 ways. Number one, on signing the contract. On signing the contract, we get a deposit. The highest deposit in this year I've got is $80,000. Now you will be surprised. Why would somebody pay me $80,000 as deposit when I'm buying a house? Okay. And we bought that deal with 10% down. So in fact, net 30,000, it was a $500,000 house. In fact, we took out $30,000 equity. So the way this deal was structured was very simply, there was a distressed seller who had $90,000 equity into the house. We took over the house for roughly 400, I think $98,000. We around 500,000, let's say it. $500,000, we bought the house. Because he had $98,000 equity, we kept his $80,000 as his equity in the house as down payment. We put our $50,000 to purchase the house, took his 80 back. So at closing, the seller received $10,000. We received $30,000 cash on closing. Okay, so we'll show you how to find such deals where you can make money the day you buy the property. Okay, so you receive the option consideration, which can be from the current seller. A lot of situations can be where the seller is in problem, they are behind mortgage due to whatever their personal situation, and they want to get rid of it, or they're being foreclosed when we purchase that property, but they still don't want to leave the area. They still want to continue to live in the same area. So we do lease back the house. So we do the same ALP agreement with them that they will lease back the house and then purchase it back from them, same rent to own with them, so that they can continue to stay in the same house. We take out the equity, we cash it or leave it as their reserve for their deposit. And the extra cash that we have becomes our kind of walk-in cash at the time of purchase.
So when you're using 10% for the mortgage or down payment, do you need to pay CMHC premium as well?
Yes, you have to. But there's a way around that. Okay, when we are putting 10% down means 10% my money. I can borrow the other 10% from private lender. Let's say I want to avoid CMHC fee because CMHC fee is around 3%, 4%. So if I want to avoid that, very simply, I want to put as little of my money, and I can have a private lender put 10% at 10%, and I can put my 10%. My goal is very simple. I want to do as many deals with the capital that I have. And I want to borrow as much as I can to do the maximum amount of profitable deals. Do you understand the Binosh? So if you have a lot of equity, you don't want to borrow, that's fine too. You can use your 20% and purchase that house. I don't prefer that, very simply, because I want to use that money to do more deals.
Sounds good.
So I prefer borrowing. I prefer borrowing. Okay. So when you're, let's say you have $100,000 in your RSP, and your another investor student has another $100,000 in his RSPs, and those RSPs are making next to nothing for you, you simply strike a deal between yourselves or between the students. You say, I'm going to put 10% of my money into your deal, and you put 10% of your money into my deal. Now, both of you make good return on your RSP monies, which is 10, we suggest minimum 12% return. It's up to you when you are striking a deal, but it has to be fair and profitable because you want to transfer as much profit into the tax-free as much possible. So let's say we give them 12% return, and now on your deal, they're lending you money, you are lending them on their deal. So normally we do these deals simultaneously or within a short period of time, and we sign up commitments and we do that. Okay, so you will receive the contracts for doing that. So then you can cross-check with your lawyers. And because a lot of these RSP holders, when you are doing self-directed RSPs, so a lot of banks will say no to you. If you have money in Scotia Bank, if you have money in TD Bank, TD used to allow that, Scotia used to allow that, BMO used to allow that. In the last 2-3 years, they have all stopped. Okay, so you will have to shift your money to banks which still allow. There are, I think, only two or three companies left right now, which allows you to do self-directed RSPs. So all you're doing is opening up a self-directed RSP account. We'll give you the names of the banks which are doing right now. It keeps on changing. We keep on searching for new ones. And so all you do is shift that money into that self-directed RSP. And now you can lend for investing at arm's length on real estate. Okay. So second way of making money.
I do have exam.
Okay, I'll be there in 2 minutes.
Okay, the second way of making money in real estate is throughout the contract, because throughout the contract you're receiving as additional rent, you're receiving as rent. So as long as you have the contract and the tenant buyer staying in your property, you will be making money throughout the contract. Okay, so it can be minimum $500, $600 up to even $2,000 depending on the deals that you're doing. The third way of making money is on the sale of the property. When we are selling, we make profit. Okay, so here is something new, which on signing of the contract, when you do that, here's something that normally is not done in the rent-to, which we have invented, which we do totally differently. Because what happens in rent-to-owns is 70 to 80% of the outside rent-to-owns fail. The reason for that is they fail because the investor never made sure the tenant buyer is going to save enough down payment. That's the reason we do the boosted saving plan, because we want to make sure they're saving enough money and as additional rent. They are saving money because of a boosted saving for them. So we do the calculations upfront when we are taking in a tenant buyer, because we want to show them that 100% they will have enough money saved up. Okay, so that's what you want to do. And a lot of rent-to-own guys who do rent-to-own or lease options, they save $200 and that's all they get. With $200, they can only save $2,400 a year. And given the current market situation, they never qualify because they don't have enough down payment and they end up defaulting, which I don't want in our deals. So when you explain it to the tenant buyer, they will understand, and you will take in only the tenant buyers who will qualify for these. You want to make sure that they're saving enough and that they will 100% qualify and they will have 100% enough equity by the time, or enough down payment saved up by the time they're ready to purchase the property. So here I will run few examples. Okay, let's say somebody's buying a house for $300,000, and even at 5%, it gives you a $45,000 of additional income, because that's added on. So what we want to do is make sure that, because now their purchase price is $345,000, and if they are qualifying with that 10% or 20% down, that they have saved up enough equity or down payment to purchase the house. So that's what you want to make sure when you're doing that. Okay, so same example, I'm running through that example. You will get access to these slides so that you will be able to run through those examples. So why we do this is very simply because we simply want to, as I said earlier, we want to save back enough money. We want to make sure the tenant will 100% qualify. Now, Ruby had earlier asked me a question in the previous session was, what will be their purchase price? So let's say we have a contract for $400,000 house at a 6%, and so it's roughly 470 something by the time of the third year. And if the purchase price is $550,000, or the appraisal price is $550,000, then what price are we selling them? Because if we sell them at 472 or whatever our contract price is, now they have to come up with the down payment. Okay, enough down payment. And if they don't have enough down payment, they are not going to be able to qualify. But if we use this system, which I'm going to show you, is the split of equity, they will be able to qualify. So when we are calculating all their monthly payments and all that, we are making sure all the taxes, insurance, principal, everything is covered. Okay, so let's talk about the additional rent. With the additional rent, after the additional rent, which we have already discussed, we will discuss now the split of the equity. And beside the split of the equity, another thing, the way we make profit is we charge a management fee of roughly $250. So this gives us an additional income. So because anytime you have a rental property, you have to charge them some because you're helping them manage the property. So let me talk about on sale here. Splitting the difference. So I'm running here example, very simple example. Let's say the building or the house was worth 300,000 and we did a 5% appreciation. So roughly it's 345. And how do we split the difference if the appraisal price is way higher? If the appraisal price is way higher, the way we do is we can sell them at the appraised price, and then we split the difference between the contract value and the appraised value. So this clauses, when we are signing the contract with the tenant buyer, we include these clauses upfront, which gives the tenant buyer the option to buy at the appraised price. So let's do that. So the way we do is very simple. So if their down payment, so this is how it works. If their down payment is 5%, we'll add an appreciation of 5.6%. If they put a bigger down payment, if they put a 10% down payment, we'll lower down the appreciation that we're adding, because now we're putting less of our own money. I have clients who have done 20% down payment and I've added 3% because I'm putting none of my money. But the way we do is, if we are doing this, we want to split the difference with the investor on the appraisal price. And let's say the house was 300,000, the end sale was $350,000. And now the market price, the appraisal price is 400,000 or 450,000. We want to split it, the difference between the investor and the tenant. Why we do that? Because very simply, it gives us additional income. For the tenant, why would he agree to something like that? Because otherwise they will not be able to qualify. Okay, so this helps them qualify because now they're buying at a higher price, at the appraised price, and it helps them qualify. Guys, any questions on this? I know this is not a common technique, but this is a highly, highly profitable technique which we apply.
That concept is not that clear. Could you explain one more time?
Okay, so let me give you a simple example, okay? Let's put an example. I think I'm going to run an example here, maybe in the slides. If not, I'll create one example here. Okay, so let me stop sharing and go back to that slide. Okay, I'm going to share very simply a screen, my Excel sheet. I'm going to stop that and open an Excel, and I'm just going to calculate for you how we're going to do that. Okay, so that will make it easy. Okay, so you guys can see the Excel sheet? Yeah. Okay, so let's take an example. Let's say the purchase price is whatever it can be. Give me a purchase price.
500,000.
Okay, let's say it's a $500,000 house. And let's say we have agreed with them. If they're putting 10% down, we'll, let's say, add 5% appreciation. The client is putting 10% down, because remember, when we are buying from the seller who is going to rent from us, majority of the times they have 20% equity. Okay, let's say somebody has a $500,000 house and they have a 20% equity. They lost a job right now and they want they bounce 1 or 2 payments and they go back to their bank to refinance. Will their bank refinance that? No, because they have bounced few payments. If they go to any other A lender, they're not going to do that because they're going to ask their payment history and they're going to see that they bounce payments, and they're not going to do that. If they go to B lender, the B lender is going to ask them to have minimum 20% equity. And if they have just 20% equity, they still have to pay the mortgage broker. They still have to pay the penalty for paying out the first mortgage. They have to still pay penalties for the default. So they might lose 4 or 5% just in that. So now they're left with 15% equity. They cannot refinance. And a lot of people, when they go to mortgage brokers suggest, oh, I can get you a private lender who can do your mortgage. And let's say the private lender charge them 10% on doing that, which becomes too expensive and too unaffordable, because now the mortgage for $400,000 is very expensive. It's like $4,000 a month, which becomes unaffordable for these people. So a lot of these people, they don't want to sell the house. They still want to live in that house. So when we provide them with a solution that we can buy the house from them, keep their equity as down payment, pay off their bank, and now get a mortgage which was close to what they had originally. Because let's say we are getting at 1.5% or 2%, and we're giving them at 3.99, they're happy to do the deal because there's no way they can get that deal. Even I've done deals at 4.99, very simply because their credit score is already messed up. So they're happy to do the deals at 4.99. And now, go ahead. Okay, now because they have the equity, we take that 10, 15, or 20% of their equity as our down payment. So whatever we are investing to purchase the house, we get it back at closing. You understand that? Okay, so let's run the scenario. And let's say we are adding a 5% appreciation on that. So after 1 year, the purchase price is going to be 525,000. Sorry, let me increase the font size. A lot of you may have difficulty. So if they're putting 10% down payment and we are adding 5% appreciation, which this is a 5% appreciation. So at the third year, it's going to be, okay. So the way we do our calculation is very simple. The purchase price is 500. Sorry, let me just increase the font size here as well. I'm just going to copy it here. The way we do is we purchase the house for 500,000. Let's say we had a $10,000 closing cost. So we're going to add that to the purchase price. So it will be this plus $10,000. So our sale price at the end of the third year is going to be $390,000. So that's our sale price. Now let's say the market appraised value at the end of 3 years, especially in Canada these days, let's say it's a 650,000. So there is a difference in equity between this and this. There's almost $60,000 equity. So if they buy, let's say the tenant buyer wants to buy and we have a contract to sell them at 590. Now, if they are buying at 590,000, let's round it up. And they need, let's say even 10% down. Okay, so which is 59,000. If they've given us already 10%, this client was 10%, so it was good. So let's say their credit score is not good and the bank wants 20%. Now they need 20% of this, which is 118,000. They have already given us 10%, which is 50,000. Now the tenant buyer still needs another 68,000. Sorry, it should be plus. Another $68,000. And if they are not able to save with the additional rent that they have, let's say they have paid us $500 a month for 3 years. So it's 500 times 36. Oh, sorry. Times 36. Oh, what's happening? Okay, my key lock. Time 36 months, that's only $18,000. So don't be surprised that a lot of them will be willing to pay because they want to save. Because all they're going to do is save 18,000, and now they still need another $50,000, which they're shortfall. And if their credit score is not good, they will agree to what we call the split of difference. Okay, the split of difference happens is when there's a 60,000. So now the sale price will be the appraised price. So now we are selling for 650. And let's say we are splitting them with 50-50 or 1/3 or 2/3, you can negotiate with them. There's a room for negotiations for that. So I give you the scale, but it's not a hard and fast rule. I negotiate with the tenant buyer as I think so far to get the deal done. Okay, so the way we negotiate is very simple. Let's say there's a $600,000 equity and I agree with them 50-50. So I'm going to get 30,000, they're going to get 30,000. So my sale price in reality is going to go to now 620. But now because they are buying for 650, and let's say they have to come with 20% down of that, which is 130,000. They have already given us 50,000. They have saved another 18,000. Okay. Now their actual purchase price, because they haven't gained another $30,000 equity. So they're gaining another 30,000 here. So it helps them qualify. It helps them big time to qualify for the down payment and purchase the house. So they don't mind. So I am sometimes flexible in terms of, okay, I'll do 40-60 split with you on the equity and buy. Sorry, I didn't hear your question. Guys, I'm going to mute majority of you, so just unmute yourself because I'm. Are you asking anybody asking a question, or is it just? Okay, so that's the benefit of it, because a lot of people, you will be surprised, will agree to a higher sales price because now it's giving them the equity as their down payment to purchase the house. All they care is buy the house and get into the house. Ruby, yes, you were saying something.
Yeah, basically, until this deal close, we are putting that money from our pocket towards their down payment.
No. The reason is you haven't taken into account, let's say your monthly payment is $2,000 and you're receiving $1,000 principal pay down.
Yeah.
You're just sharing part of the principal pay down.
No, that's true. But I'm talking about the difference of appraisal value and the agreement at the end of 30 years.
No, you're not putting money out of your pocket. Why are you putting money out of your pocket? You're not putting money out of your pocket.
How the deal closed then?
Okay, so let's say you see, is the tenant buyer's responsibility to qualify. But our job is we want to make it as easy for them as possible to help them qualify. So if they say we want to purchase at the agreed price, which is $590, that's fine too. Then their equity is theirs. But if they cannot qualify, they will default. They would rather split that equity with you.
Yeah, that's what I'm saying. Like until this deal closed at $650,000, the money is not coming to you.
Yes, so this is as additional. This is as additional income for you.
Yeah.
So this is, I think, the 12th additional source of income. So let's look at how much profit did we make, okay? So let's say we look at a very simple scenario. Okay, let's turn back the whole, I'm just going to delete this. And let's look at how much profit did you make if a house was $500,000 and we did 5% appreciation. Okay, so let's say the mortgage you got, okay, $500,000 down, the client put 10 and you put 10. So you're buying with 20% down. So your mortgage is for $400,000. I'm just going to take out a mortgage calculator. Let's say you got a mortgage at 2%, okay, which is absolutely possible given the current circumstances at this moment. You can get way less than this, but let's just, for calculation's sake, let's do 2%. So 500,000, I'm just going to do on the side. I don't have online calculator here. So let's do 100,000 as the down payment at 2%. So your monthly mortgage is going to be $1,693.80. The principal pay down in 3 years, your balance after 3 years is going to be $367,265.3. So your profit just from principal pay down is going to be $32,700. That's your from the principal pay down. And let's say the client is paying you $2,200, okay, because that will include the property tax. And let's say the property taxes is what, $350 or $300, $350. So we always add that to the overall payment, and your insurance is, let's say, $50. So your overall mortgage plus property taxes is this. So I always want to add minimum $250 of profit. So when I'm establishing how much rent they are going to pay is based on this, plus the $250 admin fee. So this is going to go this way plus this. So their mortgage, their prince is going to be this much, $2,593. And now how much profit are you making per month? Is basically you're making $500. So very simple, because we did a simple calculation here. So that's your additional profit, 500 times 36 months. So that's okay, 48. Now, how much appreciation have we received? So the appreciation value will be 590 minus our purchase price and minus the costs, because they are in fact returning back to us. We spent 10,000, now they're giving us back So the net profit is 80,000. So the total so far, without calculating additional rent or other things, oh, sorry, is 131,000. Okay. Now, even if you are giving them $300 or $400 a month, okay, let's say you give them $300 a month for 36 months. So your net profit is still 120,000. So you're not losing a big chunk. So don't worry about that. You're not losing a huge amount. And now, so it's not a deal killer what you're giving them, but if they are giving you $1,000 and you're giving them $300 a month, they are going to be loving you because you're giving them 30% return on their money. But for you, that's not a deal breaker. You got more than enough money in the game. So by investing $50,000, because the 10% the client put, you invested 10%, you have made 240% return on your money times 100. 240% return on your money. I personally, the way I do deals is I would rather borrow that money at 15% or even 10% or 15% from another investor. And let's say we do that scenario, even if I borrow $50,000 at 15%, oh, sorry, $50,000. I borrowed at 15%. It's costing me $7,500 per year times 3 for 3 years. Total, I've lost 22,000. So the net profit was 120,000.
$98,000.
How would you like making $98,000 without investing a single penny in a property?
Yeah.
I would love it every day of the year.
Me too.
Okay, that's the magic about this technique. Is that's the simplicity about this technique, that we can make a lot of money without investing our own money. And the very simple is because of the deal structure we do. The tenant is happy because he's 100% going to qualify because we are helping them save enough. Okay, it kind of not only we improve their credit score, we improve their down payment, which nobody else helps. Nobody gives them 30% return on their deposit. Okay, people are even paying $1,500 to $2,000 a month to save as additional rent. Okay, now what's the benefit of that to me? Is a cash flow. I'm receiving about the 3 years upfront my profits, because there's enough equity in the property. I don't have to pay them back. It's being paid out of the equity. And secondly, when I go to the bank or go to a mortgage broker to qualify, because I have now $2,000 additional rent as my income, when you add 5, 10 properties, it builds up a huge, beautiful income to qualify. So it gives you endless possibility of buying as many properties as you want, because now each property is not a liability, but an asset. Asset is when more money is coming in than going out. And anytime you add a property, if it's adding more money to your overall qualification, the bank is going to love it. The lender is going to love it because now they have more security. Okay, so that's the difference between the normal rent to owns, lease options, and the system. The reason our system has been so successful is because of that. Because we've been so in depth understanding that problem and finding a solution to it.
I have a quick question.
Absolutely.
So at the time of the tenant closing the deal, if they are coming short of the down payment and we are splitting the equity into like whatever percentage agreed upon.
Mm-hmm.
So like they need to come up with the 20% down, right? At the time of closing to show it. How does it work out?
So there are a few things I want you guys to remember, okay? One is when you're doing the deal upfront, I want you to calculate how much do they need to save each month as additional rent in order to have 20% down payment. We do this calculation upfront because then there's no surprises. We tell the tenant buyer, this is how much you need to save. Let's go back to that simple example that we had, and let's do the calculations there. Okay, so let's say they're buying a house for 500,000. After 3 years, it's going to be 590. Now they need a 20% of that, of 590. So they had already put $50,000 down because they had a 10% down. Now there's a shortage of $68,000. Okay, let's just round it up, $68,000. Now, if they have 3 years, divide that by 3, means 36. Oh, sorry, it calculated me as a percentage. Divide by the 36. Let me change the cell to numbers. Okay, they need to save $1,800 extra a month. People are not able to afford and pay that $1,800 a month to save up. It's not that easy. So when we show them that you need to save $1,800, the guy may say, okay, I'm able to give you $1,000 extra each month. So let's say we are giving them 30% return on their money. We're giving them $300. So they still have a shortfall of $500. So if they are shortfalling, let's say $500 or $600 at the end of the deal, times 36 months. So let me just do a quick calculation. 600 times 36 months. They're shortfalling 20,000. Do you think I'm willing to lend them 20,000 as a second mortgage and make 100,000? Absolutely. So I become the lender at that time. I charge them 15%. I put a second mortgage for 20,000 and I help them close the deal. Because that 20,000 is extra profit. So I'm making 120,000. I walk away with $100,000 cash. I give them 20,000 as second mortgage and I can close the deal. So I become a lender now because I want that 20,000 to be paid back in 2 years. I divide that by 20,000. So let me go back and share how I do that 20,000. Very simple. So let's say I'm lending them 20,000 at 15%. Oh, sorry, 15%, which is 3,000 a year for 2 years. So another 3,000, that's 6,000. So total 26. I'm just doing a rough calculation. I use mortgage calculator to amortize it. So total is 26. So all I'm doing is asking them to pay that 26,000 divided by 24 months. That gives me an additional income of $1,000 a month. Okay.
If they are not able to afford that.
Oh, that's fine. I can do it in 3 years. You see, you are the lender. You play the game. So if they are not able to do it in 2 years, tell them in 3 years. In 3 years, they refinance and pay you out. Okay. Because you're walking in with a good chunk. You're walking with 80-90% of your money cash. So let's say we are making $120,000 or $130,000 out of a deal. Would I want $110,000 cash today? Absolutely. I want $110,000 cash. I don't mind lending them $20,000 because it's secured against the house. And I'm making 15% return on that money. And that's, let's say, even if it gives me $500 a month for 4 years, I'm happy with that, because now that $500 becomes my income to qualify for more mortgages.
So either splitting the equity or like financing second mortgage, that's better way.
Yeah, that's why I say you see, when you're as a real estate investor, you want to have a lot of tools in your toolbox. So what I'm giving you is a lot of tools for negotiations. Not every tenant buyer will agree to everything. So you have a lot of options to play around with them, and so that if they win, you win. Any other questions, guys? Kelvin? John? Arun? Anybody? Piotr? Guys, ask me questions. I need you to ask me questions.
This is Piotr. I don't have any questions. I need to digest those things first.
Oh, sorry, who's talking? Always mention your name because I don't know who's asking.
This is Piotr.
Yes, Piotr. Yes. What's the question?
I don't have any questions. I'm just saying that I need to digest all that stuff you just threw out.
Okay, no problem. No problem. Absolutely. So anytime if you have questions, this is recorded. It's going to be available. And if you have any questions, just shoot me out the questions. We have done over 300 deals this way. So we have mastered it. We have done it. Okay. So I want you to, any questions you have, just ask. John, Michael, Michelle, sorry, Michelle. Arun.
No, I guess I need to.
All right.
digest
Sorry.
also.
Yes, Michelle, you
Yeah,
had
sorry.
questions.
I was muted. Being in Quebec, the traditional big five banks are comfortable with this type of financing?
You see, that's the problem here. So there's one thing I want you to understand. In Quebec, and now starting in Ontario was always comfortable with this kind of rent to own and lease option deals. Now they're starting to get uncomfortable. For the last 1 or 2 years, we have started noticing. So the way we get around that, so we found a solution to that is we open up a separate account for each property we buy. So let's say the client has given you $50,000. So I put $50,000 every month. I'm automatically transferring whatever the additional rent plus the bonus that I'm adding into that account. I'm still controlling that account. Okay. When it comes, let's say almost 3 years and they're ready to purchase the house, I add their name to my bank account, which you can do. Okay. And now the bank prints out a statement for the last 6 months showing their name that they've been saving that money and now they have enough down payment.
Okay. Do I have to open up a separate LLC for each deal?
No.
No. Okay.
No.
Okay.
I normally put 2 to 3 houses per LLC. Okay, so what you want to do is put them on a cycle, because when one is about to expire, you put the next deal into it so that you can retake those LLCs. And the other thing, okay, again, I'm not your tax advisor, but my goal is to always give you the street smartness. So what you always do is, because you're retaining the LLCs,
Mhm.
Any renovations, any cost, purchase costs or house related costs now becomes deductible because you purchase the next property into the deal.
Right.
Okay, so it helps you keep more of your money with you by purchasing the next property into the LLC, but I don't want to put all the eggs in one basket. So I want to, LLC doesn't cost much. It costs $300-400 to open up.
Mhm.
So I can open up a second LLC and put the money, the deals into that.
Okay, good.
Anything
So
else?
a question is whether we should register few corporations at a time or should we
No,
register?
one at a time, one at a time.
Okay.
The reason for that is you're not getting any discount for opening more. So when you are ready to open, the thing is that for qualifying for a mortgage, the bank is not going to give you mortgage based on your number corporation. You are still the guarantor. You are still going to be guarantor. So even if your corporation doesn't have a 2-year history, it's okay. After you have 5-10 properties, now your corporation makes sense. Now they look at your corporation's assets, but because you're buying in the initial stage residential houses, you are still a guarantor. When it comes to commercial, yes, you can have an option whether you want to be on the deal or you don't want to be on the deal, because your rental income is more than satisfying and you can tell the lender, I don't want to be as a guarantor. Okay, I become a guarantor in majority of my deals because I can get better rate, very simply. But the secret to that is you don't want to own any property as a guarantor. So if you have 100 houses or 100 properties and you don't own a single in your name, what difference does it make if you become a guarantor? Nothing.
So you sign a personal guarantee, it means.
Yeah. Okay.
Okay.
So I prefer being a guarantor, very simply, because it gives me a lot of leverage and the bank thinks I've got skin in the game, so that it becomes very easy to get the mortgage approved. But I don't mind because I'm not putting any property in my name. Okay. Any other questions, guys? Guys, I'm a straight shooter, so I'm giving you a lot of the golden nuggets and a lot of things, and I just want you to tell you that I apply them practically, but I'm not your tax advisor. I'm not your legal consultant. Okay, so you are real estate investor in your own way, and you do the things in your own way. I'm just your guiding light. Okay.
When
So
we choose
When you,
second buyer, are they finding the house or we are buying a house and giving it to them?
So in this system that we are teaching you right now, there are two techniques we use. One technique is when we find a good deal, we buy the house because we know the market, we buy it. Okay, like I'm helping one of the students now buying in London, Ontario, house for $289,000. Okay, it's a detached small house. We're buying for $289,000. It just came on the market and we immediately grabbed it. It was a distress sale and we grabbed it. Okay, so in this case, the student is able to make way bigger profit because now he's going to do the ALP at 350 as the starting price. So he's a walk-in immediate $60,000 profit. Okay, because the market is hot. When you have a tenant buyer who already has given you the deposit, the way we do is once we run the ads, let's say 20 inquiries come and these clients have 20,000, 30,000, 40,000 or 50,000, like we did another deal in, I think it was, we did another deal in, I'm just going to mute. Sorry, Michelle, I'm just going to mute you. So we did another deal. It was in Kitchener area. We found the house And we advertised extensively to all our tenant buyers who had the money, who were in our database. I think 15 people showed up. Out of them, we asked everybody to bring bank drafts, and 3 clients came up with bank draft 20,000. It was 35 and $45,000. When 3 clients came, we did the deal with one with 45, and we immediately informed the others and sat down with them and told them that we'll look for a house in the area for them. So we closed 3 deals for that student. And the way you do is you can close those deals within 2 weeks. Again, I'm not your legal consultant, okay? I'm giving you the loopholes. If you close those 2 deals or 3 deals within 2 weeks, you can close with the same mortgage, with the same income. So you can buy, let's say you have 100,000 declared income, you buy with the 100,000 one property, you qualify. But if you do the closing within 2 weeks, you can qualify for all 3. Okay? When you're declaring, because they are all closing in short period of time, you did not declare at the time of mortgage because the other deals were not closed. So you didn't, realistically, nothing wrong. Okay.
In other words, if I'm buying a lower priced home prior to getting a tenant buyer, then I can choose my price. Okay, I bought it for 280.
Yeah, you have to be realistic. You have to be realistic, and you can mark up. Because remember, these tenant buyers are desperate tenant buyers who could not qualify for a mortgage and they want a house badly. Okay, and there's no other way they could get into the house except through you. So that's why it's a very good way for them and very good way for us to make the money. Any other question, guys?
So I have one question about that. When you put tenant buyer's name on your bank account, is that safe, I guess?
Yes. The reason for that is we don't give them the signing authority. It's just for statement purpose.
Okay.
A lot of banks will agree to that, that they are not the signing party. Okay, they will be our future beneficiary.
Okay.
Okay. Any other questions? So all set? Okay, guys, it was lovely talking to you all. Shoot me any questions you have. Hopefully by the end of the day, we will send you that form. Please fill up that form because I want to get the funnels ready, up and going so that we can have the funnel set up for you guys. Okay, take care.
Thank you.
Bye.
Bye.
And one more thing, Simran will be getting in touch with you. So I want you guys, if you're liking the training, if you're loving it, whatever you're not liking, I want you to talk to her and discuss whatever you're liking. I want you to talk so that we could get some testimonials from you. At the same time, we can get the feedback from you. Okay, so please attend Simran's calls, and she's our director of client satisfaction. I need your feedback because I don't get the time get the feedback of every student, and I'll need your feedback. I need your comments, and I need your support as well to understand where we are, how we can take the game to next level. Okay.
Thank you.
Take care. Bye.
Okay, thank you.
Bye.